In the face of unprecedented wealth, I'm shocked to discover that most people behave badly. At some level, it's not a surprise.
Something's broken in the way that we're evolving as humans if everything ultimately reduces to what's in it for me.
Would you prefer $2 billion in thinking machines, unlisted stock with the chance to be amazing or the chance to go burst, or $3.5 billion of liquid Facebook stock over the next 5 years?
What I'm hearing Rory say is essentially reduce it all to the big VCs. They're playing the momentum game. If shit happens, they can handle it. This is life. Everything in life you can price as an option.
Ready to go? Rory, what was it like co-investing with Arthur Rock?
I actually have invested with Arthur Rock, and I'm totally willing to talk about it. That shut you up, you little punk, right? And let me tell you what it was like investing with Arthur Rock. He was the scariest dude I ever saw, right? He was old at that time and just as grumpy as when he was young. And when he said things, you just trembled in fear. So it was pretty awesome investing with Arthur Rock, actually. And you just heard a guy speak who was literally the first VC on the West Coast who did Intel. And he was pretty direct. It was great, is the answer.
Well, there we go.
And you thought it was just a rhetorical bullshit question.
I did. I mean, Arthur Rock was like 1960s, 1970s. I mean,
he was still doing deals in the thing. He was still doing.
You were old, but
I did. He was still doing deals in 2004. Absolutely. So yes, Arthur Rock wrote checks in 2004, 2005. I was in a board meeting, only one or two. He was pretty damn impressive.
Yeah, Jason.
And as I say, you just were scared because
I mean, no one's going to argue with him, are they? It's like, are you... Nah.
Yeah. No, the sentence, Mr. Rock, I think you're wrong when you said that, just did not come out of my mouth. And I'm pretty punky, and I was even punkier then. But no, I'm going with, this is received wisdom down from the mountain. This is, carved in tablets. I'm taking it as read. By the way, we lost money on No, we didn't actually. We made money. We made money on that deal. Yeah, we did. Took a long time.
Rory, when did you start in venture?
1993.
I was born in 96.
Oh, that killed the conversation. Just fucking
dead. Harry, you think it's funny, but I say, when you come out here and you go to YC Demo Day, you're going to feel old now.
Dude, I already feel old. I was in Stockholm for Project.
You're not young. You're not. I mean, when the three of us met you, you were young. You're not young anymore.
I hope we're just taping on this. It's great content. But my partner, Andy, has this great line. He says, the real problem with this industry, he says, there's a huge period of time where everyone says you're a little too young. And then there's this brief shining moment where you're good. And then there is the, when is he going to retire moment, right? And it seems to me it's like 10 years each and 3 years in the middle. And what the fuck?
What about the moment when someone comes out of it and decides to do another institutional fund after being wildly successful? That's the craziest one of all, isn't it? Why would anyone do that? Why would anyone cash out at the top of the game, go out and manage their own capital, and then have to deal with LPs? What a headache, man. That's like a sucker bed, isn't it?
Dude, my favorite thing with that is LPs. For the first three funds, there's no DPI, there's no DPI, there's no DPI. And then you return a shitload of DPI, and then LPs go, but are they really hungry anymore because they've made a lot of money?
That is so true. That is so true. You can't win, Harry. You can't win.
It's so true. I had LPs, Roger. I don't know if you noticed, who were like, but is Roger still hungry? I'm like, have you met Roger?
I just dialed this shit in, man. It's all for the ego.
Guys, before we dive in, there's one bit in a last show with Roger I did, and he said, I plant both feet on the ground every morning, and I say, let's fucking go. And I just love that. It's so good.
That is so Roger.
I say that to my AI agents now, too. But they've been the problem is they've been working all night. I'm already exhausted by the time I say it to them. You think I'm kidding, but I'm not. They've been working all night.
It's the strength of your relationship with your AI agents that's just beginning to worry me ever so slightly. I just want to put that out there.
What a world we're living in. Can you believe when we all started in venture, obviously at different times, and here the four of us are?
Totally.
It's just like, what is going on, man?
It's a good time in a bad kind of way.
Guys, I'm so excited for this. We have a very special guest in Roger, one of my favorite people from the industry. And we're going to start with very fresh news that Industry Ventures has been acquired by Goldman Sachs, $665 million as the starting price, with I think a $300 million increase depending on performance over the next 5 years up to 2030. They have $7 billion under management as a asset manager. I wanted to start with this. How did we analyze and how did we think about this on the breaking of the news last night?
Good for Hans. Good for the founder. He grafted for 25 years. It felt like, I think it was just after the crash in 2000, built that secondary business and, great entrepreneurial act and well done. I mean, let's start with that. Just well done to the guy.
Can I ask an ignorant question to Roger and Rory, maybe? I should know that. I don't know how fund-to-fund economics really work. So at first I read it and it's like, one, congratulations for not pushing to $1 billion. It's like 970 with the earnout. It's like, congratulations on letting the ego walk it back and not putting your fist on the table and saying it in 2025 founder language, it has to be over the top. Like that was one thing. But then I stepped back and I thought for a minute, hold on, they've got $7 billion under management, right? And here's where the math, like I should know this, I don't. I know it's a fund of funds, but imagine you're taking home a minimum of 20% of that, right? You could do more. That's 1.4 billion. What am I missing?
No.
What am I missing in the math?
You're missing the math.
I know I'm missing the math.
Yeah, because it's just, you don't get quite that much. You're implicitly asking two questions. Maybe one is, how are asset managers valued? And then separately, if you're the owner of a business, when should you sell versus keep it and just keep the income stream, right? On the first, look, this thing traded at roughly 10% of AUM, right? And I actually went and looked it up because what's the mental model for assets under management to kind of enterprise value is very varied, which makes sense because there's different models. Carlyle and KKR, where they own all the economics, they roughly trade market cap 20% of AUM. In other words, if you manage 100 billion, the entity is worth 20 bill, right? Here, which makes sense as a secondary because the economics aren't typically quite as good as primary investors, it's at 10%. Right. And then you can go all the way down from there to kind of public asset managers trading at, 1 or 2% of AUM. Right. So at 10% felt kind of about right for this kind of thing. It's, I think, a little bit in line with Stepstone and Hamilton Lane that are publicly traded fund of funds as well. So it felt around the right price. Right.
Much as I hate to agree with Rory, because I don't know, I have so much joy disagreeing with Rory. I actually used to be in this business. I was in financial institutions, M&A at the very beginning of my career and sold asset managers. His analysis is spot on. This is being kind of a hybrid. And if you look at it as a multiple of revenue, if you think of, so Jason, if your numbers, the 20%, if you were to say the expected earnings of that pool is 20%, as a fund of funds, I get 10% of that, right? So it's like 2%. So call it 140 million. And then you get some management fees on top. But of course, if you were to say 20%, it's probably not 20%. It's probably like 13 or 14%. And you adjust it, then you're saying it's probably like 10 times revenue for a very, very solid business with a great brand. And I honestly do think that, they had started out early in the primary business. Actually, Industry was one of the first institutional LPs at IA. So they were in IA 1 and 2. But obviously their secondary business now dwarfs their direct and their initial investing business and funds. So as kudos to Hans, it's been a grind, but they have really ridden the wave beautifully. But I think it is a straight on market deal.
And for GS, the rationale behind it is they can push a huge amount of their private clients into industry moving forward.
Yes. It's a platform for them. Look, all the public asset managers are desperately trying to get into private assets because, at the most basic, the S&P, you can get your S&P exposure for less than 10 basis points versus, 2,000 basis points running private capital. So if you were an asset manager in public stocks, your business is eroding away super fast. Active management's going away. If you want to be an asset manager, and Goldman is a big asset manager, getting a platform like this that you can expand just makes a ton of sense. So you're right, Raj. They're probably paying 10 times sales, which on a 50% margin business is 20 times earnings. It's a very healthy price, but they're sitting there going, we can jam this through our channel, expand this 10x, and, keep our asset business going with some high return, frankly, high expense, high fee assets when, your public assets aren't nearly as profitable.
There's also one other point I'd like to raise. You're 100% right, but just a little insight on Goldman. So Goldman has this platform called Apex. And Apex is a platform that is for their high net worth individuals where they bring these kinds of deals, primary and secondary deals, to their ultra high net worth clients. This is something now where they can actually institutionalize it, create much more product. And it's something else to give to their ultra high net worth clients. Plus, industry itself has institutional clients that can now become GS clients. So it's kind of a win-win, both from a product perspective and from a distribution perspective.
I'll tell you what I like about it. Maybe I'm in the wrong platform, but I get these calls from Morgan Stanley to invest in private equity. And first I'm like, have you looked at my exposure? Like, don't you have access to my account? And the ideas are so dumb. They're so dumb. They're so dumb. And I'm like, if as long as Hans and team stays, I think they said they had like 18% IRR over history. Like if that's every day in and out, that's a good baseline for folks to get into, right? If they can productize that, I would take that 100 days out of 100 versus the crazy calls I get from Morgan Stanley. We'd like to get you a little more private equity exposure. Well, I'm 90% as it is, guys. But maybe 95 is the right diversification.
And I think the other thing to note that's interesting is, what kind of GP-led businesses can in fact be 100% sold, right? And I think the interesting insight is probably not a pure venture firm, right? Because if you can't sell 100% of benchmark, because then you don't have benchmark, because you don't have the 5 great guys who are doing benchmark out of, right? Whereas this, it's a more productizable business. It's got a lot of secondaries. It's a lot of fund of funds. Just like, Greenspring, which was a large LP in scale, got sold to Stepstone. Same kind of thing. These are the kind of businesses that can be sold 100% into a larger institution, right? And it can work for both sides. Obviously, the seller gets a great capital gain and the buyer gets kind of something that they can blend in. You couldn't do that with a venture firm, I would argue, right? Especially a small venture firm, because in the end, all you have is the 3 people, and if you cash them out 100%, then you don't have anything, right? So, I will admit at times over the last 25 years, you kind of look at the secondary business and you go, that's not nearly as interesting as the business we're in. I love being a primary investor. I love doing my deals. But one thing you recognize is you can't sell this business, and Hans could sell his, and he did. So well done, Hans. Who's laughing now?
It's the fee stream. You're 100% right. Like you had mentioned, like the Blackstones and the Carlyles and folks like that, asset gatherers. I mean, ultimately, Hans is an asset gatherer, and most of the revenue from it comes from fees. And it's not he's built a machine. I mean, kudos. It is he built an asset management business. The rest of us here do not run asset management businesses.
Well, give Harry time, but point taken. Give Harry a couple years.
The more your business is predicated on either a brand or some institutional thing, the more it's like a business and the less it's like just 3 to 5 partners picking great investments, the more monetizable it is. I could totally believe that your media company with a venture fund attached could be monetizable in a way that Roger's fund or my fund will never be, right? Scale will never be, right? Obviously Andreessen, who is clearly embarked on the AUM and great investing journey to bigness and maybe an IPO, believes the same thing, right? There are some businesses that are
General Catalyst, same thing.
I agree. General Catalyst stated the same thing, and I would argue Y Combinator, for example. Not saying it gets old, but it is the definition of a business. It's independent of the greatness or not of the current operators. It kind of has heft over and above that, right? Those kind of things can be sold. But if your only asset is, we're going to talk about Roger's new fund in a second, but let's be clear. The only asset in Roger's new fund is Roger's IQ as a stock picker, God help us, right? And, so, without Roger, there's nothing, right? I thought that was good, Roger. I thought it worked in nicely, right? And that's just not a non-monetizable asset. And it's a continuum, but maybe you can sneak out as a media company. Roger and I are just destined to stay here and be simple, humble stock pickers.
This is so nice. With Roger here, you give him shit, not me, and you defend me. This is great. This is like deflection. Roger, nice.
Anything for you, Harry.
Dude, you're too kind. Now, Jason, this next topic, I felt that you might have a perspective on, given our prior chats. Andrew Tulloch leaves Thinking Machines, the company he co-founded and raised $2 billion for, to join Meta for a reported $3.5 billion. Well done, Andrew Tulloch.
Yeah,
listen, I hate this term.
Better luck next time.
I'm triggered.
Should have done computer science.
I'm triggered.
Jason, what did you think, dude? I know you have.
Well, not only that, literally, I was on LinkedIn just yesterday, and a founder I've known from a distance for a while. I didn't realize he'd left his unicorn and just raised $20 million from Excel to do his next company. I'm like, I guess it's totally cool today to do that. I guess it's totally cool to leave Thinking Machines, or didn't it happen with Ilya's co-founder too? Right? I mean, who went to? I get it all confused. Who went to Meta? I guess it's just cool to forget about raising $2 million a demo day and quitting or keeping the money. Now it's cool to raise a couple billion and check out. I just don't. And if it is, I don't know how ventures should adapt, if at all, right? Is it just a risk factor when you invest in Thinking? What was the Thinking Machines pre-money? 10 billion or something like that?
It was 10 billion post.
Good God. And so people are checking out of $10 billion seed companies now. I honestly don't know what, I feel like a fuddy-duddy because when I was a founder, good God, I mean, there was no way I would leave no matter how tough it was with my start. I would just never consider it. And now it seems like it's cool, man. It's cool. And even your accelerator will take you right back after you quit.
And this next sentence is genuinely not meant to be snarky, Jason, even though it's going to come across as it. Yeah, you absolutely wouldn't never quit. You would hang in there, but you also probably never face the existential dilemma of being offered $3 billion to quit. Right? Because most of the time, most people independent of their startup aren't worth a multiple of their startup valuation. If they're lucky, they're worth, a $500,000 a year salary. Right? So, I mean, in the face of unprecedented wealth, I'm shocked to discover that most people behave badly. The loyalty conversation erodes pretty quickly when you're into the third comma.
That's all fair. I understand the words. And again, you said fuddy-duddy, I didn't. But the fact that the notion of these are people that backed you and believed in you and supported you, and you just peace out and do something else, I do have a bit of an issue with that. And there's levels to this shit, right? Where yes, the person sitting at the helm of a $10 billion post-money company, and their shares $2 billion, and then they go for $3.5 billion. To me, I look at that and I'm like, are you fucking kidding me? If my kid did that, I would not be happy with my kid. I would be like, you leave the people that brought you to the dance because you see a prettier girl over here. It's like, I don't know, man. Something's broken in, I think, the way that we're evolving as humans if everything ultimately reduces to what's in it for me and there's not another vector involved. And I'm a super competitive, but I am a wildly competitive guy. I want to win, but it's not at, any cost. And let me say one more thing and then I'll create some oxygen for others. But some of these deals like Scale AI were basically, I saw that and it reminded me of the old style, the asset purchase versus a stock purchase, right? Where I don't want the liabilities. I don't want all that other stuff. I just want this asset, or in this case, I just want these people. And that has now become de rigueur. I mean, it's hard to call it an acqui-hire when you're talking about many billions of dollars, right? But essentially, it's an asset purchase. And I think that's something we'll continue to see more and more of. But I feel less badly about that than I do what we're talking about right now.
leaving aside the morality question, which I reserve the right to come back to and take a different perspective, the interesting question Jason asked is, what do you do? What protections do you have how should investors handle this information, and what should they do differently going forward? And what should other founders do, right? I mean, to state the obvious, you see this interesting thread where founders are realizing extended founder vesting and cliff vesting and stuff like that, and protections for them versus a co-founder leaving are a legitimate part of the discussion here, right? Now, it may not even have mattered. He may not even have made his cliff, right? But it does point to being very sure that you and your founders have extended vesting. I mean, for example, if these shares weren't subject to vesting, then you feel even stupider as both a co-founder and an investor. And I mentioned the co-founder to make it clear, this is not just a VC's taking care of themselves perspective, though we'll come to that in a second, right? Purely if you're a bunch of founders, if you're 7 people leaving a safe job to go do this startup, you got to run the game theory of how will I feel if one of my 7 co-conspirators bails on me, and what should the economic penalty be to them? So if I'm a founder looking at this, I would be thinking about, is there cliff vesting? Is there 6-year, not 4-year vesting? Is there repurchase right? Are there ways to make sure that this doesn't happen? And if you leave for a competitor, something really bad happens. So I think that's got to be on the table because, even as a founder.
Well, I'm just saying, Rory, is this not just symbolic of the conversation we had before recording, which is the increasingly transactional nature that we're seeing in rounds, which I moaned to you about? I'm a romantic. I like to fall in love with a partner, whether it's, an investment or a romantic partner. It's super important to have the relationship. And now it's like, hey, highest price, auction process, 0 relationship. And this is just the embodiment.
Well, I think that's been true since we met here. I think it's just become institutionalized with AI, with deals being done on a Saturday for 9-figure or 10-figure. What I worry about, this is just me. I'm an early. We're mostly early stage investors here. We're all relatively early stage. I don't believe liquidation preferences matter. I don't believe they're a big deal, despite what they say next. But my liquidation preference has always been, and I put it in quotes, not true, knowing the founder would never quit. That's my protection as a seed investor. Forget the preference stack or 1 million raised or 1 trillion. If I know Roger's never going to quit that's the best protection I can get as a seed investor. The regular stuff is at the margin, right? But if I am investing and he might quit no matter how good I think he is, he might quit in 6 months for something better. I guess you can adjust it on a spreadsheet, but it's a risk I've never taken in my history. This has been my downside protection is he won't quit. She won't quit.
The interesting thing here is the core asset in these investments is a group of 7 engineers, which is pretty unusual compared to most deals you do. I mean, let's be honest, most of the time, and correct me if you're wrong at the seed stage, but the stage we're investing at, you spend a lot of time with the CEO, you meet the VP of Eng once, you just assume it's a good team, you look at the product, you try and do your due diligence, but you're not, you're not leaning in and saying the 7th of 7 co-founders in a list is pivotal to my investment thesis, right? So it's different here because we're talking not about the motivations of a founder person, but the motivations of an engineer person who was like an engineer, academic, then reminder spent 14 years or something like that at Meta, went to OpenAI for less than a year and was at Thinking Machines for less than a year and then went back to Meta, right? The unusual... As a career trajectory for an engineer, that's not crazy. I was this longtime engineer, place A. I bounced out to this other place, left with them, and then decided I just want to go back to the original place I was. It's kind of not an unusual pattern of behavior. What is unusual in this case is, because of the technical nature of these bets, how much reliance we're putting on the behavior of an engineering/academic talent pool, which probably responds fairly differently than the I'm a founder, I want to be the CEO talent pool.
Well, but Rory, that last thing to me is the bit, right? Which is, this isn't just job hopping and then, eventually going back to the place where you kind of earned your stripes. It's founder responsibility. And I think that's what's lacking here, is that notion of, if I am taking on this mission with a group of people, with a set of capital partners, that conveys a measure of responsibility that I'm discharging. And the minute that I say, you know what, screw that, my responsibility is to me and my not optimal out. I wouldn't even say it's the optimal outcome, the maximal outcome, the near-term max. Like, who knows whether or not this is better? This may well not be better. But the fact is, the people that they left behind are kind of screwed.
Agreed, but I'm going to go back. And first of all, I'm going to do the money because I've known you for years and you're a financially astute person. Question, Roger, would you prefer $2 billion in thinking machines, unlisted stock with the chance to be amazing and a chance to go burst, or $3.5 billion of liquid Facebook stock over the next 5 years? Just as a pure financial call. How
obviously.
Yes, thank you. So let's not pretend that they're equivalent. I mean, it's such an obvious.
I'm not saying they're equivalent.
10 to 1? 10 to 1 better?
Maybe. But there's obviously way more option value in thinking machines, right? If that could be a $500 billion company.
No, you're exactly right. You have embedded option value versus probably highly fixed $3.5 billion plus or minus 50% versus $2 billion could be 0, could be 10.
I do also think, Rory, the context of who gets it and when they get it. The dude was at Facebook for 14 years before. I don't think he was exactly desperate for cash. And that
agreed. And I said 14. I'm doing that from memory, but it was circa 10 at least, right?
But it makes a difference. The dude has got 100 already, being blunt.
True again. But again, back to, I wonder, and I could be wrong on this next sentence. I'm just, again, don't love the behavior, but just advocating both sides. You, Jason, you made a comment and Roger made a comment, quote unquote, this person made a commitment, right? I wonder, when I look at the due diligence process for that deal, right, where you have a very charismatic CEO in Mira Murati, right? I wonder how many of the VCs met him. Was there any emotional connection? I'm just wondering here, did any of them even meet him in person? Right? We're talking about this, he made emotional commitment to his colleagues, to his co-founders, yes. But as a VC, I'm not going to lie and say, if you were due diligencing that deal, obviously you got to spend your hour with the founder. You didn't get to know what the product is because they're not telling you that. Did you spend an hour with this guy or not? I don't know.
As a VC, you should be fired if you write $100 million plus check and you don't meet the co-founders, period.
I'm with you, but Rory's point is, how deep do you go on the org chart, right? Also,
and I'm positing in the context of a transaction that came together where you didn't even get to know what the product is, I wouldn't assume a whole bunch of emotion. I'm just pushing on the bullshit. I wouldn't assume a whole bunch of emotional connections on either side. Yeah, the big picture thing is you thrust a bunch of money at people, some of whom you met once or twice, some of whom you maybe didn't meet at all. And, less than 12 months later, one of those folks, you went back. Oh well.
So what I'm hearing Rory say is essentially reduce it all to fuck the big VCs. They're playing the momentum game. If shit happens. They can handle it. This is life.
Yeah, exactly. Big boys rules. Yeah, people who have $1 billion shouldn't give out to other people who decide to grab it. and you might think it's bad behavior. You might think you wouldn't back him again. But let me give you a clue. It's the prisoner's dilemma. Once you're not playing a multi-period game, and when someone offers you $3.5 billion, you're no longer playing a multi-period game. You're playing a one and done, right? You're going to get bad human behavior. Frankly, the real thing is you as a person managing money should be thinking about how to deal with those corner cases. And, I don't know how you can is the hard thing. If you're paying $10 billion pre for a raw startup where there's proven evidence that the asset, which is those 7 mines, will be pursued by someone who's willing to offer them $1 billion, it makes it real how risky those investments are. And I'm not sure what the answer to that is. It's quite terrifying, really.
The answer is a bigger fund.
What?
A bigger fund. Yeah. You could have a few of these.
Diversification. Got
you don't want to be too concentrated with these deals.
But Rory, the way you said that was a really astute way of putting it. You're right. It's like what used to be a series of multi-turn games when one looked at their career. If somebody acted badly and burned bridges, that might be their last company. They might not found another company. Here, if you reduce everything because of the scale, right, to a single turn game, then that wildly increases the volatility of potential outcomes.
You're exactly right. Because look, I must say something here. Roger and I lost money together in a deal, And I would say every one of the management team in that deal behaved well, and every one of them is referenceable by us and, would give them money again, depending on the deal, and have talked to them about other deals, right? It felt like a multi-period game. Everyone will stand up and did the right thing, right? I think you're right, Roger. This kind of sums just change the calculus, and you can't all rely then on people doing the right thing. And you just got to plan accordingly, and how you do that is TBD.
Roger, rule number 1, we don't admit that Rory's right, even when he is. Okay? This is rule number 1. You can't, to be fair, that was very astute. No. We don't say this. No.
Harry, I haven't worked together with Rory in a while, so I forgot that rule. My apologies.
Yeah,
it will not happen again.
Rory's cheating on you with Arthur Rock. Don't worry, it's okay.
Yeah.
Okay. We said he left OpenAI. SoftBank reportedly securing a $5 billion margin loan secured by ARM shares to invest in OpenAI. How did we analyze this? And if they're getting loans to invest in OpenAI backed by ARM securities, how do you think about that? And what did you think of it?
Masa rules. Nothing new to see here. This is what he does. For better, for worse, when he has a feeling, he goes all in. All chips, max risk, personal, financial, everything. This is Masa being Masa.
100%. I mean, this man is, full risk on all the time, and just wants to get the bet on the table, and has been spectacularly right at times and spectacularly wrong at times, but spectacularly willing to play, which on behalf of the audience, we should be eternally grateful, right? And he's not even that levered. I mean, I checked, actually. He owns 90% of ARM still in SoftBank, and ARM is trading 90-odd billion. So he's got 80 billion of equity there. He can lever up some more. I mean, and if he can, he will.
Jason, what did you think?
Yeah, that's what I did think this was. At first, it seemed and I think it does tie into the story of where the hell are we going to get all this money to fund the tokens that I burn every day as a vibe coder. Like, we still don't have the answer. But reflecting on it, when I thought more about it, I mean, and it's actually a smart use of leverage. If you have a $90 billion, $100 billion position, I don't know, if you're an individual, you certainly don't want to pay capital gains on it. A $5 million margin loan at an acceptable interest rate is probably a smart position, right? That loan's not going to get called, right, under any scenario, probably, right? But it is kind of weird. It still feels like part of this whole, we're all believing in Sam, which I do believe now, but we're all believing in Sam. That trillion in revenue's coming.
Just for the record, let us remind ourselves that in 2002, the NASDAQ, you did see individual stocks go down 90% from the peak. So it is possible the loan will get called. It's just unlikely.
Yeah, the question is, let's just for ease of analysis, let's say that ARM is 100 billion, right? That's leverageable pretty much to 50 billion. Now, but it very easily could see him back in the news with an incremental 20 billion. He could lever this. He could take 25 billion against the ARM position easily. And then to Rory's point, and we saw this, like, the thing about Masa, and again, I'm old enough to have seen, the NASDAQ run up, the NASDAQ crash, Masa being Masa. And I mean, he has had so many existential moments where he's waking up in the middle of the night, sweat pouring down his face, wondering if this is it. But he's held tight, and he didn't go over the line. He went right to the line, and he's come out, and then his macro theses have been proven out. So to me, this is like a relatively low octane Masa move.
Exactly. That's exactly right, Raj. Yes.
That's a great visual for the show. Masa surrounded by fires with low octane just around it. And the thing that I find hard is, like, when we said about kind of where does the money come from, and then the speed of just what we're seeing, we're now building more data centers than office buildings. And, we're seeing demand for compute be the single biggest constraint. And I'm looking at this going, really? The bubble that everyone's saying, in comparison to we're building more data centers than office buildings and demand for consumer computers just off the charts, is this Is this not fundamentally different?
I think was a lot in that. I mean, the counterpoint between building data centers and building offices. It sounds clever, but it's to some extent trivial, because who the hell's going to be building offices? Because there's no one in them, right? The reason we're building data centers is because we want to put computers in out of the rain, and the reason we're not building office buildings is people are staying at home. So it's pretty obvious what you'd build, right? But I think stepping back, I mean, the wider comment is, we go around this, is it a bubble, AI CapEx spend for a while, and over and over again. And it's funny, I was reading over the weekend that there's this new Stripe Press have this, is it Dwarkesh Patel's Scaling AI, an oral history of scaling. And I kind of read it over the weekend. Really good, right? And the thing that impressed upon me was the matter-of-fact way that a number of the people just reiterated. It was just interesting to hear it, reiterated, one, that the scaling law has been proven to hold for 6-7 years now at a high degree of accuracy. And a couple of them blithely said, it wasn't a question of when. It was like, they were literally saying, how long did it take? Of course, it was of course we'll need 1% of GDP to invest in computers, but then we'll be fine because we'll have AGI. My point is, what I find fantastical, because that's a shit ton of investment, they were like, well, that's just what it's going to take. And of course, we're going to get to that. It was the matter-of-fact way in which, the smartest people of our generation thinking about scaling AI accepted that this was kind of the to-do list, right? So that's a long-winded way of saying it's not just, frankly, Sam spiffing out of his butt. It's like a whole bunch of these folks are like, yep, this is the task we've embarked on ourselves for the next 5 years. And it's going to take around 1% of GDP to build a compute cluster big enough to get the flops, to get the outcome we want, right? So they're going for it, right? It's back to what I said. So it's just happening, right? And then the only question is, how does the capital get found and can it earn a return, right? But if the capital is provided, this is going down. These data centers are going to be built. You can see these guys going, this has just held for 6 or 7 years. It's totally predictable. The loss function is predictable. It was kind of like, why? Well, of course we're going to buy, 10,000 computers worked, so we're going to buy 100,000, and then we're going to buy 1 million, and somewhere along the line we'll get AGI, and what's your point, and why are you even questioning it?
I can tell you just one thing for what it's worth. For me, just forget the macro stuff. So as Mr. Vibe Coder on the group, I vibe coded 8 apps. I haven't built a piece of software. I've been part of building this piece of software since 2012. I vibe coded 8 apps in 100 days. And we have 12 AI agents working at SaaStr now, replaced almost all of our sales team and our whole content team. What I can tell you from that, and folks have been saying this, I wouldn't have believed this 90 days ago, but folks like Amjad or Replit are saying, you've got it backwards. Everyone will consume every available token. And what I know is today, just what we're doing today with 12 agents and 8 apps, I could use 100x the tokens. Even now, I got to wait 20 minutes to build one feature. I mean, vibe coding's cool, but it don't work at Google speed. Our agents could all do more. So if everyone today could use 100x the tokens, and think how early we are on the journey, right? I mean, as we record this, it's Dreamforce week, right? Harry's going to be there, I think, this week. And as Mark points out, only 0.1% of Salesforce customers are really using AI yet. So it's 100 times 100 times a something. I really do think we are not, I can see it myself, we're not remotely servicing the demand that exists today, right? So how it gets paid for is a different question, but I think this is so different than the prior waves where we just can't even service this demand.
The only thing I would actually question you on, because I'd love to hear your thoughts on it, is my mental model of this is from a technical and demand perspective, it's all going to happen because the people who are building it want to build it and Jason at the margin wants to use it. So if anything's going to constrain this, it's going to be economics. And my big picture model here is, you've got the technical trends and then you've got, the economic trends. And the question is, will it get the return? I mean, will the capital be found to offer? I think if it's slowed down, if it's wrong, it won't be because the technology direction is incorrect. It won't be because the demand isn't insatiable. It will be purely and simply at the margin. The marginal capital provider says, oh my God, people, even though the scaling law is holding, the economic return from that investment isn't holding. And, the scaling law might be log linear, but every economic phenomenon tends to be diminishing marginal utility. And at some point, capitalism is going to say, I don't know how to tell you this, guys, but you can't have your $1 trillion dream because we just can't afford it. And we're going to have to slow down a little here. And that's what I'm trying to figure out is, are we going to get the economic return quickly enough to warrant the investment? And, back in the day, you were a financially astute investor. And what do you think? I mean, put on your trading and thinking hat here.
No, I think I think you've nailed the dynamics. And yes, economics will dictate that not everything that people want to build will be built, because the capacity won't exist once diminishing marginal returns reaches a point where the value of the capital is not met. And I guess, one vector that I'm not clear on, and clearly the people that you're citing, Rory, are a million times smarter than me, is if there are step change advances in processing efficiency or simplification of code such that the amount of processing required per unit it declines in a way that people don't expect, is that going to relieve some of the pressure on the magnitude of infrastructure that's being built?
I don't think so. I think we burn more tokens. Every company's like 30%, 50% of my company is built with AI. Our engineers, hooray, our engineers came back, 50% built with Cursor. Does that mean they take the rest of the day off? No, what it should mean is they're shipping more features, right? Because instead of spending an hour on Stack Overflow trying to find a library that was stolen or pseudo open source, I can do it in 60 seconds. So I just go build another feature. It's just, and the better that gets, the more tokens you'll consume. I don't think there's this great efficiency coming. I think we'll just build more and more stuff faster and faster. That's why it's actually so stressful at seed today, because so many of these companies are born almost instantly. They're born almost instantly today. So, it's tough doing the A and the B and the C and the D and the E, but seed is really hard today because that company probably didn't exist 7 days ago, or being less facetious, 30. And when we all started, even when Harry started, startups were never good 30 days in. They were terrible. I mean, once in a while, like an off the chart CTO would build demoware 30 days that your jaw would drop. But if you picked at it, it didn't work, right? But it's just crazy what you can build so quickly today. It makes it so competitive. It's complicated.
Lovable had their first year anniversary the other day. And I thought that was insane. First year anniversary, over 170 million in ARR. Wow.
It's great, but it also makes that pre-seed inception phase harder, I think, because how you can't intuit differentiation in the way you used to be able to with a little bit of software. Oh my God, Aaron and Dylan built a folder you could put a file in. I'm in. Those days are long gone. How did they do that? You mean it stores on the internet? Get me Rory.
Yeah, no, it's moving a lot quicker. You're right. And you make a comment here, it makes it hard to be seed. You're right, because you don't know. It makes it also harder to be A and B because you have to pay up. I mean, let's be frank, we're all looking for this really, it's pathetic when you say it from the entrepreneur's perspective. What we're really looking for is that wonderful period where but it's not obvious and you can invest, right? And it turns out that period may have declined to like a half an hour. Right? You have the preceded lovable. Then you have like day 3, it's exploding in revenue, and suddenly you're at 2 billion pre. Right? So, and it's an exaggeration, but not by a lot. 6 months ago, they were raising at a couple of billion. So the time period from we haven't launched yet to, oh my God, it's so obvious, has, as Jason said, compressed to the point where it's just, that sweet spot is vanishingly small. And therefore, you're left with the choice of, do you invest into acute uncertainty or do you invest into 2 billion pre?
Acute uncertainty or businesses that aren't specifically disrupted by this phenomenon, which generally have like legal and regulatory challenges that make it not simply, do I have better, faster, cleaner code? There's a bunch of these other issues to address.
And is that your thinking? Because, what we didn't say it at the start, but Roger's getting back on the field, proving his timing is as always brilliant. And is that your thinking when you're back on the field or as a seed investor?
It's part of it. The stuff that we're doing definitely is less resistant to the phenomena that we're talking about on this call. As you well know, Rory in particular, but you got the rest of you too. Acute uncertainty does not trouble me in the least when that acute uncertainty is expressing a deeply held, well-researched thesis that I have. And that's just the nature of very early stage venture. But I do think that the issues of legal and regulatory complexity, and again, it's whether it's financial infrastructure or it's media rights, copyright, patent, IP, it makes it more nuanced than am I able to develop the next base model or a great platform for developing applications at warp speed.
I think that's fair. I think, actually, we had Aaron talking to some of our LPs. I'll maybe come back to that later. But one of the concepts he introduced was something I've been thinking about at the apps layer. And Aaron for Box is always so crisp. And he talked about the diffusion rate of this technology across, enterprise as a whole. And there's going to be different diffusion rates. The diffusion rate for a lovable will be very different than the diffusion rate of AI for complex medical prognostication, right? And having a handle on that and having and setting your expectations accordingly and your investing thesis accordingly and varying it by virtue of the diffusion rate, I think will be one of the key skills here. Right. And assessing, recognizing that some markets it's going to be done and dusted in 6 months. And you're right, Roger, other markets where there's regulatory constraints, you might be 2 years in before you get your first big lighthouse, vertically focused enterprise customers, but then it's bowling pin and you get the other 5 in 6 months. Right. And there's going to be very different adoption patterns by industry.
Harry, I'm not going to say it, but somebody might have said some relatively smart things right there.
I was paraphrasing someone else.
That Aaron Levy, he's a smart guy.
Roger, what you don't know is that I prep Rory before the show, and I sit down, I share my thoughts, and really.
Yeah, I'm just prepping.
I know he's parroting you. Yeah.
Yes.
You said about value in regulated markets, maybe where it's more difficult to be disrupted. Rory, and Jason, we had this great chat last week on the ability to kingmake and how capital can be used as a moat. We discussed, Jason, you very well and eloquently discussed Polymarket raising $2 billion at $9 billion, and then this week Kalshi, the direct comp, raises from Andreessen and Excel at $5 billion, again right after Polymarket's raising at $9 billion. How did you think about this? Kingmaking not possible? What was the thoughts?
I mean, this is let's be honest. What's going on here? This is the purest regulatory arbitrage play of all time. Okay. If you can look at the cumulative market cap of regulated sports betting and look at how it has dropped in response to the rise of Polymarket and Kalshi, who are not subject to the same rules and regulations that they are. Literally, it's we're going to take value here and we're going to place it over here. And the combination of, at least in the United States, the current administration being extremely predisposed towards the prediction markets companies. And now Kalshi's announced that they're going to India as part of their 140 country coverage. If there was a level regulatory playing field, this would not be happening. But for now, this is one of those circuits. So you talk about kingmaking. I think to an extent, they are trying to run as quickly as they can to get so big and so powerful that they will not face parallel regulatory scrutiny that the legacy companies have suffered through since PASPA.
Jason?
That was in my FTX investment memo, was to just get to that scale where we could push through some of these issues. I feel like we just came up just a little short. If we could have just waited for our buddy David Sachs to get in, then I think we would have really had a fun returner on that one. But it's a good point. Listen, you're obsessed with kingmakers, and I think it's a good topic, Harry. I think it's right. The only thing that fascinates me on this kingmaking topic was that literally Polymarket was founded by a solo founder in his toilet during lockdown. A solo founder in his picture on Twitter in his bathroom. That was the only place he had to work during the worst lockdown of March 2020. He founded this. It gives me inspiration that new founders will come out of everywhere, right? And so king making works. It is a real issue to talk about. But if you can solo found Polymarket out of your toilet in March 2020, who knows where the next one's going to come from?
I'm going to push and just bring a couple of things. One is, I actually think this is an example of king-making not mattering, right? I think Roger nailed it correctly on what's going on here. This is two non-sports betting companies who are doing, quote, prediction markets, where all we talk about is the 10% of their revenue that's political and 90% of their business is sports betting, but we're not calling it that. And they're just killing it because we all love to sports bet. Right. And the number of people who give a shit about, who's going to win the Nobel Prize or whatever else they're betting on that's not sport betting is low. But everyone in America wants to bet on the NFL and they're cleaning up. Right. And good luck to them and Godspeed. Right. That's just what's happening. Roger is totally correct. Separate comment on the king making. The implied, just tracking back to last week, because my short-term retention from memory is actually longer than a week, Harry. We were basically saying that money can pick a king. Right. And I think this is an example, and I've been thinking about it since we talked last week, and I think this is an example of where it can't. There's two good companies. They're both getting a ton of money. They're going to slug it out. They're going to get relative market share. But I don't think, they both need capital, but I don't think there's king-making going on here for a couple of reasons. Because there's two reasons king-making work. One is if you give one company so much money that they can overwhelm the other, then maybe that's king-making. And then the other is where getting money from brand name perceived VC makes the customers default to you, right? And that actually happens in enterprise software. If you're, if you're awesome CEO and then you get 3 awesome VCs and you're selling mainly to tech companies in the valley, you probably have a herding effect. I think Brett Taylor is an example of someone at the high end. There's a perceived, Sierra is amazing, would you want to take them on kind of vibe. I don't think that's true for a second. I don't think anyone betting on Poly or Kalshi gives a damn how much money they have, provided they can pay their bet, and gives a damn who that money came from. Right? So I think this is an example of non-king making, to be very clear. I think it's just making the bet. Right?
I think it's definitional. Like, what does king making really mean? I think to me, king making means something different. Here it's and to me, king making doesn't need to be one company. Call it an oligopoly, right? A small group of companies that receive an exceptional amount of funding relative to everybody else. Here, I think that what I would refer to as the king making is more money to spend on marketing, distribution, and team. And that, because at the end of the day, bonusing, like, that's what makes these companies go around, is the ability to
spend money on marketing.
Exactly. As long as LTV to CAC makes sense, and that's exactly what they're doing. So to me, that's the money. But you're right. Customers don't give a shit. They don't care how much money Kalshi's raised or Polymarket's raised.
Agreed. And look, to that extent, you're right, Roger, in the sense of every time someone gets money to something that's quote a king making, because you need money to pursue your business. And you're right, these are oddly enough, they will become capital intensive businesses because you're right, it's the spiffs that will drive it, right? To get new customers. It's just like Uber, right? But and you're right, so at that level, you can define anything as king making, because whenever you pick 2 or 3, when 10 companies could enter a market and only 2 or 3 do, and then they suck up all the capital, that's king making. But I would argue we were defining the term more tightly to say you can pick the winner. I don't think these are picking the winner as much as, you're backing the winner. And there's a distinction in terms of, the point is this, am I as the venture person making the difference? The hell I'm not, right? That money could come from anyone. As long as Polymarket has enough to pay out their spiffs and meet their CAC, the money's good, right? There's no anointing here. If you think back to king making, there's the anointment process with oil. There's none of that here. It's just you've got money to play the game. But you're right. There's no doubt that any of these games that become high velocity, it's impossible to play. To take the other extreme, it's impossible to contemplate a bootstrapping world in this game right now any more than it was possible for Uber, any more than it was possible for, the kind of LLM game, right? Many of these high growth businesses, thank God, lose money and rely on us in venture capital to fund that money, because otherwise we wouldn't have a damn job, right? If they could all bootstrap, we'd be forced to work for a living.
Am I also, I'm probably allowed to say this because I'm outside the borders and we're not going to go into a political, but am I the only one to also realize that Eric Trump is on the board of one, another Trump is investing in the other, Howard Lutnick's son happens to run the fastest growing investment bank? My word, that seems like an awful lot of coincidences in one go. I wish I was as good at picking as the Lutnicks and the Trumps. What a great deal, huh? For a regulatory arbitrage play, Roger.
It was like the old days when you could work at YC and have your own fund at the side. You didn't have to invest through YC. It's a great deal.
100%.
If you're in crypto, energy,
smoke a deal,
gaming, prediction markets, right? There's those handful of things which this administration has very tight connectivity to, and if you want help and support, and you're in one of those industries, it's extremely clear what the playbook is.
Agreed. Which is why, as an intellectually coherent political philosophy, is to say regulate as few things as possible, because the more things you regulate, the more of this kind of behavior you see, right? And, I think, that kind of behavior you tend to see from every party, because the minute something is regulated, people have an economic incentive to incentivize the regulators, right? I will say, I think the only real objection people have is the current generation appears to know how to do it at scale. We're not going to do trivial little jobs where, I get a nice job when I leave my regulatory position and I get a nice $500,000 a year job. No, we're just going to go wholesale here. Just give me 5% of the company. It's just so much quicker, right? So the efficiency of the regulatory arbitrage has definitely gone up. But I think the zoom out comment is whenever you have regulation and there are economic incentives to get close to the regulators. And I think that's why, as I say, you should have a bias to regulating as little as possible, especially on economics, if at all possible.
And I think this space is actually particularly interesting because you also have this issue of, structural budget deficits in a lot of states that regulate gaming. And there are differential tax rates depending on the jurisdiction. Then you have these massive offshore operations of things like Bovada and Crypto.com and Stake. And these companies make billions and billions and billions and billions of dollars. And the more that, Illinois jacks up rates in state, the regulated sports books that are subject to these rates reduce investment in the state, handle goes down, tax revenue goes down, and those customers that are now getting poorer service are going to trade offshore in unregulated markets. So Rory's right. Again, Harry, sorry. But, in this case, this is such a clear example of, you can see how as levers move, it has these effects in other parts of the market, and generally where it's heading is the unregulated part of the market.
Something that you said, don't piss off. I always think don't piss off Peter Thiel. And Peter Thiel's made a very concerted concentration play in terms of AI bets, very much all in on OpenAI. And it just struck me, because it kind of was a piece announced this week where they shift from caution to concentrated AI bets, meaning they were out of the market and now they're obviously very in the market, but with few players. But what struck me though was, I've interviewed Hemont at DST. Hemont at GC. I've interviewed the team at Lightspeed. I know the team at DST, and they've taken the completely opposite approach of, we don't really know the winners, so let's be in Mistral, let's be in Anthropic, let's be in OpenAI, and let's just index this wave of the best companies. Given the venture brains and Rory, phenomenal wisdom, may I add, that we have, thanks to experience, if you didn't know, with Arthur Rock, guys. Rory does.
Oh, for God.
Poke.
I wanted to hear your thoughts. How do you think about these two opposing plays in this new world and where you would sit?
I'll tell you my guess. I want to hear what Rory has to say. My guess is being too diversified from investing in AI today is biding time. It's not knowing, not having the conviction, not knowing. And I think it's better to bide time than to completely stay out. There's plenty of reasons to do a check-in to leaders, even if it's not going to 10x the fund, rather than to be grouchy or sit it out or criticize these rounds. But I think if you're Peter Thiel sitting on what he has, you want to go concentrate. I mean, he's 40%. He's like 40% of the capital in Founders Fund plus his own capital. Making little teeny bets, little play checks doesn't get you there, does it? But if you don't know, I would do 100. If you don't know, you might as well do. If you don't know, if you're still, the world is this world is so different than 9 months ago, right? I think Plan B is to make a lot of bets.
I think that's actually right. There's a lot to unpack in this, so we'll take a little while, right? One is, look, we've discussed this. Diversification reduces your upside. That's the nature of it. It also reduces your downside, right? I mean, it just is. It's the central limit theorem. It's not a great insight here, people, right? You will have a wider variance of returns positively and negatively if you have 10 deals in your fund than 30, right? Literally, the math is clear, right? So there's nothing there, right? So logically, the more certain you are that you can call the shots, the more focused you should be, right? And I think Founders Fund both has the evidence that they can call the shots because they've done so, and frankly, the confidence to call the shots because they got it, right? That I totally understand why they're going to try and be more focused, right? I actually looked at the article and I was honestly surprised at how diversified the information shared. Founders 1, the Growth Fund had 31 investments. Founders 2 had mid-high teens, and Founders 3 is aiming to have 10. Right. To me, I was actually surprised at how diversified Founders 1 was. It just didn't feel in sync with what we've seen from these guys in general. I mean, if you look at their SpaceX non-diversification, these guys strike me as the most likely to be most concentrated. Right. So there was nothing surprising to me in that announcement. The only surprising thing was they weren't there already.
Roger, how are you thinking about concentration with your new fund? You're back in the game. You want to do 100 investments out of your new fund, or you want to just do 5 big ones and go big and go home?
To me, over a 3 to 4 year initial investment period, obviously fund ones tend to go a little bit faster, more like 2.5 years. I tend to be 20 to 25 portfolio constituents, and just to create the farm team, but with significant ownership from each of those checks. But then where I've tended to get very concentrated is on the second and third checks, and where we've gotten deep conviction in a team, their execution in the market, and the fact that if they continue to execute with that skill and at that speed, that the market opportunity is massive. So we end up historically, and I'm following a similar playbook, of 3 to 5 companies out of the 20 to 25 companies constituting 75% of the capital deployed.
75.
Roger, is your fund big enough then? If we run through that, 20 average 3 million checks today in 45
They're not average 3 million. They're not average 3. Our initial check is way less.
Are you going to get ownership if it's going to be a smaller check size to that, given seed round?
It is in the spaces I'm investing in.
And they still exist.
I mean, we just wrote a 1.5 check at a 10 post, so 15% ownership in a really cool analytics company that, is disrupting a seriously stodgy and screwed up sector that I think is generalizability outside of that space. So yes, I do think it's possible to write those kinds of checks. And then assuming they do a great job, then we'd love to write a $3 to $5 million second check into that company. Maybe more.
I'm switching to Roger's fund. I want to find these deals. It's been a few years for me since I've gotten enough of those. I'm switching over.
If you're listening to this podcast and you can't see people's eyes, what you're seeing in Harry's eyes is the wide-eyed look as if, can such things even exist? A 10 million post for a company with a product? Can such things exist? And yes, they can.
And multiple 6-figure ACV clients.
Yeah, I believe it.
5 on 50. I'll do it. 5 on 50. And I'll do it.
And Roger, and therein lies the danger to your model for that follow-on check, which is the existence of people like Harry who'll just snatch it away from you at a high price. But coming back to the concentration, I actually think, Roger, again, at the risk of being nice, that's exactly the right strategy, which is, because it's not just we're going to focus. Yeah, it would be easy to say, we're going to be concentrated. But I think what you're saying is correct, which is you have to start off with a significant element of diversification and then concentrate down. And in fact, this is top of mind for me. We just had our LP meeting, And we would typically be at least a turn later than you, Roger. But my big picture comment was, we've moved from a world where an exit is 200 million in ARR to a world where an exit is 400 million in ARR at an IPO, right? So you're just doing your thing here, but way over there at the finish line has receded another 2 or 3 years, which means logically you've got more risk and more upside. You just got to hold these things longer, right? So when you think about that, at the margin, that should have some impact on your portfolio strategy, right? And for us, we typically been at our stage under 20 deals per fund. And we kind of said, you probably need to aim to closer to 25, just given this dynamic. Just nothing's changing at the stage we're at, but success is further away, right? Now, and then, like you say, trying to concentrate back down, because in the end, it's no insight, but just to say it again, diversification is the enemy of upside. Concentration gives you more potential, more variance, but you have to do that. You have to do that very aggressively on your follow-ons, right? And that's a very different strategy, just to call it out, Harry, back to your thing, than what Founders Fund articulated, but it's worth pointing out they're articulating that strategy for a growth fund, right? And the big aha here is how bifurcated and different stages of this business are. When you're still at the will this thing even work stage, which is Roger, or will it scale, which is where we are, or maybe Jason somewhere in the middle, right? You probably need some significant diversification and then concentrate. When you're effectively investing in what should be public companies, but are just private, then the growth fund strategy should be 10 or 11 or 12 deal concentration, right? So it doesn't lend itself to a one-dimensional answer, right, on that. And I think that this question of how to handle portfolio concentration and, what should you be aiming for is just going to be a key part of making the math work.
My challenge here is that I've done the portfolio reviews, and when I look back on Fund 1, where there's a meaningful timeline to actually look back on the 6 years now, the best performers, your linears of the world, were not obvious early, and the early outperformers did not signify enterprise value in the long term. Clubhouse, Hopin, Be Real. And so if you think you can pick your winners early, I think you are wrong. Am I wrong?
But yes and no. Yeah.
But more yes than no.
I think one of the aspects of the strategy articulated is this temporal many turns in order to be able to see progress. And yes, it may affect your ownership if, in fact, you don't have that high degree of confidence at the earliest days and you're leading or writing massive checks into every round. But for instance, there was, and I've got these very, very different ways of getting to multiple fund returners. They did not all look the same, right? TTD, multiple near-death experiences, multiple exit opportunities, bridging multiple times, didn't have a product in market for more than a year and a half. So that's one all the way over here. And then once it hit, then it hit. Then you had something like Wise, which was chugging along. Not that they didn't have hiccups along the way, but fundamentally, that was as close to an up and to the right company that I've ever been involved with. So there it was, my first check into Wise was $750, right? At a 5.5 post. Okay. Yeah. Oh yeah. Yeah. And then, Valar came in, and then we piled him with Valar to 20, and then we piled him with Valar to 160. And we just kept going. And we were 17% at TTD at IPO, and we were 13% of Wise at IPO out of a little shitty seed fund. But then Datadog's a great example of one that ended up being a fund returner, but we had 2.2% at IPO because we were in there at pre-seed, and then RTP led the seed, and then Index led the A. So we were not comfortable in that, being honest, to back up the truck at either the seed. The A we wanted to, but it sharp elbows, we couldn't get what we wanted in there. We were able to write a check, but not as much as we wanted. But we ended up having 2.2% at IPO. But that still was incredibly valuable because that was a $40 billion company. I'm just saying there's multiple paths, but the thing is you're playing going all the way back to the beginning of this, because this is a multi-turn game.
Yeah. In other words, and just bringing it back to this point, what you're saying, I think what Roger's doing, he's rejecting the absolutism of your statement, which is that you just don't know earlier on, and he's giving something more. There's a nuance, which is you don't always know, but you know more than someone coming in from the outside. So at the margin, you can tilt it your way, and that's all you can do. They're not going to put a big sign saying, "I swear to God, I promise you, this one's going to be a $10 billion outcome," right? But you should. As long as you have a differential information advantage and the willingness to use it, what you're saying, I think, Roger, is you can tilt the thing slightly in your favor, which is all you can do, which is all concentration is. I do think, by the way, after you get in revenue, it's much more. I mean, the stage we're invested, I do, with about a 70% confidence level, once you have a year or two of revenue, you know, right? And in fact, I can say that exactly because we've discovered, we did the math. If you get the first 2 years that we underwrote in terms of revenue from the moment of our investment, if you get the first 2 years correctly, your probability of getting greater than a 5x goes from 30% to mid-70s. In other words, once you're in revenue and you have product market fit, the probability, you do have a lot of information and you owe it to yourself to use that. I do agree. So therefore, at the seed stage, it's by definition less than that information, but it's not zero. It's not flip of a coin, is my point. And I think Roger's point, you know. So if you think back on yours, there probably was signal there, if you're close enough to it, to be able to just tilt the allocation slightly. And it can make a huge difference.
100%. Yeah.
And I've realized, as a comment on that, Ross, it's interesting to talk about it, because I've realized even at our stage, you've got to be trying to do that more and more, because the journey from our stage is still 10 years now, whereas before it was 6 or 7.
Jason, what do you think at seed?
I think here's what I didn't totally, I sort of got this, but now reflecting on the conversation, I see what I've learned. You can get a relatively high degree of certainty at seed, not the certainty you get late stage. You can get it, but what it means is you gotta have you're gonna end up with a pretty small box. You're gonna have to hunt strange things outside there. You're gonna have to be a founder attractor magnet. You're gonna have to do something, because you're going to turn away a lot of the deals. You're going to do the wises, right? But you're not going to do the other one that Roger said. Maybe you won't do the trade desk or something. I don't know, or whatever. You're just going to turn away some of them, and you're not going to do the clubhouses because it's wacky, but it might be great, right? But you can still do wise. And I think that's my error, because I'm concentrated from first check, right? And so I have to turn away something where I don't have certainty, even if it's cool, because the risk is too high. I'm doing 8% of my fund into almost every deal, right? So I have to have such a high hit rate at seed. Now there's exceptions. I'll do some small checks, but that's really where it ends up being. A check and a half is 8%. Like half of them have to work, right? So it's a stupid model, because you have to turn away Clubhouse and Hopin and maybe even Datadog, but you got to just find the wises and go all in. But it's a big trade-off. But I do believe that you could just cut those ones out of fund one and still have a decent fund.
That's so interesting, Jason. That's so interesting. Yeah, I mean, for me, the 1% to 2% of the fund at entry, that's what we do. And then it's that next check that could be for 5% of the fund or 7% of the fund. Like when we did DigitalOcean, our first check was 3. And then when Andreessen came in and led the $37 million Series A, we wrote a 7. So we had 10 million in 2 checks in Datadog. We ended up having 9 million over 4 checks in Wise. But that was a much smoother function. But in the case of DigitalOcean, we could just see it taking off as reflected in Andreessen's leadership. And we're like, you know what? This is going to be one of our best companies.
But what are you going to do today when you got in at 8 million post, like the one you talked about, but the next round's at 300 because the AI kids come in, or 500? This happens all the time today. How much of your fund can you really put? Like, is it even worth writing that second check? Is it even worth getting out of the office?
It depends. We are hyper disciplined. We look at every check independent of the check prior, period. That's the rubric. So if I look at that and say, the information I've got about this being a 300 million or 3 billion, right, is I think this could be a $100 billion company. then I will write a very meaningful check into that company up to about 10% of the fund, which is exactly what we did with Trade Desk when by the time we had written 4 checks, pre-seed, bridge, and then a check into a Series A, which is barely a Series A. It was at a 16 post. Okay. We just crawled to that point. Then it was whoosh. Then there was an air gap, and there was nothing until the $20 million Series A, which was 15 primary, 5 secondary at a 280 post. And we wrote a $3 million check out of a $50 million fund into that at a 280 post. Okay, after having cumulatively written a little over 2 million over those first 4 checks. But that 3 million ended up turning into 40 million. And that was a great investment.
Sometimes I wonder today if that math works as well, right? Because let's say you did the seed at the one that you did at 8 and you own 15%. Okay. And how big's your fund today? 150 million or something like that? Maybe I think it was just 100. Okay. And then the next round's at 400. Okay. Now listen, you could go to 10% of the fund, but you're going to the impact on your ownership it's irrelevant. Like you're going from 15%.
Who cares about ownership? It's a cash on cash business.
Fair enough, but it won't change your carry or your personal economics all that much to go from 15 to 15.1. Like it's just not
the issue. The issue is if it goes from 300 to 10 billion and that check's a 30x.
I think. Can I try here? I think there's an embedded concern in what Jason's saying that is not articulating. But when you articulate it, I think it's okay. It's like what you're saying is if all the follow-on rounds are priced incorrectly relative to ultimate exit value, does your strategy work? And it's a fair question, and it's the question you would ask if you're living in Silicon Valley in 2025. But
don't invest in those rounds.
I was going to say, to save Roger the trouble of making the point, I'll say that then if the worst thing that happens is my initial check gets marked up, and on the follow-on I don't need to chase the money, then I'm money good on the check I've written. Every check I've written is money good. And provided every check you write is money good, in the end you'll die rich. It's just one of those things, right? I actually feel the need at this stage to remember that I was on a board with Roger for years, and for the longest time, because he'd worked in finance before this, and this is a compliment really, Roger, for the longest time I actually thought he'd been an options trader, because no one I know understands option value better than Roger. And I think halfway through you explained to me you'd actually worked in risk management, core and IT in, I think, Bloomberg or Goldman or someone like that. But I do think you've got a very good understanding of option value here, and it's just showing true, right? What Jason is saying is a fair comment, which is sometimes all those options expire useless because other people are paying too high a price. But over time, it's a good model. And from a downside, all that happens is you don't write checks at silly prices, right? And you don't get quite as much ownership. Yeah, if the rounds trade up to the point where the follow-on round doesn't have the return, so be it, is your point, Roger, correct?
Yeah, 100%.
And I think the odd thing, the reason I'm kind of so focused on this is my big sound is as the exit bar has gone from 200 to 400 to 900 or whatever it is, right? More of those dynamics are going to even pervade the business we're in. Because if you back into it from exit, this is what you're dealing with.
For me, I think of like the next check as the opportunity cost of cash, which is like that cash can be deployed elsewhere in a new option, so to speak. And as you see the price inflate, and I get it what you say, the exit potential inflate too, but as you see the price inflate, the multiple does compress to some extent. And to me, I'm always like, shit, I think the opportunity cost
But Harry,
of that cash.
What is the risk-adjusted value of that capital? That's the question. Every time, whether you're writing a check at a 10 or at $1 billion, that's it. So you take into account all of those variables in order to make a decision. It literally, everything in life you can price as an option. Rory's heard this spiel. I walk through life. Everything looks like the Greeks. Everything looks like options theory because that's life.
And what he's saying is you have information there. Right.
Yeah.
And
I
again,
do. And, yeah.
and it's also worth the Peter Thiel quote at this point, which is the big learning he had is, and it is true, is when you do a deal and then a big reputable outside investor does a follow-on round at what feels like a high price, do everything you can in it, because there's a lot of signal in that. And it's not always true, and I could cite examples of it where it's not true, but risk adjusted, information adjusted, that next round in the deal that you've been in that's performing well, provided the follow-on price is contemplatable, the advice would be adjust your scales upward. Don't be guilty of anchoring on what you did. You got to find a way to take into account the information since then, both operational and the outside round.
One nerdy thought, and maybe Roger, you can educate me offline sometime. When I started investing, I learned from Founders Fund. I came up with that 10% threshold to put 10% of the fund into your winners. I've done it since I was able to do it myself. The mathematical problem I've had is, imagine you have 3 or 4 potential winners in your fund, right? You do exhaust a lot of your capital relatively early. And listen, I'm not as good an investor as you, and I never will be, but I have come to regret some of my third checks, because I just wish I had more flexibility in the midlife. I wish, because yeah, but you can get up to that 10% limit pretty damn fast if you have more than one breakout, right? And you can be super disciplined and say it has to be OpenAI or better, but you could exhaust, if your fund's 100, you could exhaust 30 or 40, $1 million of it if you have 4 breakouts in today's world. You could even do it in a year potentially. Right. And maybe it's okay, but you run out of reserves. You run out of capital.
You're right. And I think what Roger is saying is he wants that to happen.
I know. I just think if you're on the board and you're not checking out, if you're going to be on the board for 10 years, you have, even though the founders are now allowed to quit whenever they want, tying the start to the end, they can check out any day they want today. I think if you're going to own double digits, my view ethically is you got to be there till the end. Otherwise, you're dead weight on the cap table. You don't get to check out after 24 months and say, great job, guys, and show up once a year to as an observer. You gotta show up, and sometimes that means writing more checks, right?
Sure, but that's one of your core investments. But the other thing is you can always write small support checks after that, just like I'm participating in the round, but I'm obviously not driving it because I'm investing. I've already invested $10 million out of my $100 million fund. That's one thing, but obviously in terms of stewardship, it's one of your core investments and you will be with it until the day you're done. The second thing, and this is something that's a whole other set of conversations, which we could potentially have another time. And one of the ways that I very intentionally structured IA as we move through time is parallel LPs to be able to do cross-fund investing. And that's a very hard thing to do, but if you can do it, because create that title line.
For people that don't understand that, you're saying have the same LPs across funds, and so you're able to have cross-fund investing without conflicts.
That's exactly right. So it does not become this existential issue. And by the way, we dealt with this with a portfolio company in IA1, where IA1 and IA2 did not exactly have matching LPs. And it was a conversation, like the LPAC was like, we showed them the analysis, whatever. If you want to do it, go do it. Just understand, like, if this doesn't work, you got some splaining to do. So it was the risk of that check was not simply financial, it was reputational. Ultimately, we ended up deciding not to write that check. In the case with later companies, Fund 2 and 3, when we had parallel LPs, then all of a sudden, we weren't investing out of a $100 million fund, we were investing out of a $260 million fund. 1 plus 160.
I think that's true, and we do cross funds too. The only comment I'll make is actually it doesn't directly address Jason's comment, because we're really direct. Any cross fund you do is going to be a good deal. Otherwise, you're an idiot, and you're not an idiot, right? So I think I think good deals, you can find follow-on checks where you can cross-fund, even if the LPs aren't fully aligned between funds, provided you run a process, because it's a good deal. And in the end, right, what I think the separate comment Jason was making is, I mean, bluntly put, how much do you keep back for your marginal deals if you're stuck in them for 10 years and you want to be supportive versus playing early in your best deals at the risk of not being able to follow on checks later? right? And, I heard your answer, Roger. You're basically cold-bloodedly allocating to the very best deals, and you're willing to have 100 grand. Hey, I'll try my best with 100 grand. I don't have $1 million left in my pocket.
Correct. And, at some point, if, obviously we try to get to between, 110 to 120% invested through recycling. Recycling dollars can be used for those purposes, but I'm not going to optimize my asset allocation because of the potential of uncomfortable conversations down the road.
Yes, I remember one of those uncomfortable conversations, and you didn't optimize your allocation for it. He said, just keeping score, Roger, not that I forget. It's only been 10 years. Yes.
Wow.
And I remember what our other larger investor said to you at that point in time, vividly.
I might remember that as well. This is great. This is fun, Harry. Thank you for inviting me.
Listen, Arthur was busy doing the board work that Rory should have done. Guys, this has been so much fun to do. Thank you so much for joining me. I've loved having you all.
Thanks so much, guys.
All right.
Great seeing everybody.